Hello and welcome to our webinar masterclass on mergers, acquisitions and exit and the systems and tech implications of those things. I'm delighted to say that we've got 255 business leaders joining us on this call and a panel of experts from Freeman Clarke, all of whom have been involved in numerous clients and their mergers and acquisitions, and by Sophie Tainton from YFM Equity Partners. YFM are a PE firm that we know well. They have been providing growth and buyout capital for low and mid-market businesses for over 40 years. Sophie's role is to help management teams to achieve their value creation plans. For those of you who don't know Freeman Clarke, we are the largest and most experienced team of IT leaders in the world, and we've got clients, mid-market, ambitious businesses, the length and breadth of the UK. Let me kick off by asking a simple question of the panel, just to go round everyone, which is thinking back on recent transactions, what's one thing you wish you had done differently? I'll start with you, Jerry.
Thanks. I had a situation where I was brought in as the CTO to a particular business, and all through the process of getting that role, it was all fine. But then day one, I was told, "Oh, we just last week we just actually bought a company that we were going to now integrate into this business." And I said, "Well, that's what a great bit of news! How exciting! And what's the plan?" And they said, "Well, that's your job. So you'd better crack on and get that integrated." And you can imagine at that point, it's rather too late to start putting together an integration plan.
So you were the plan, Jerry.
Yeah, that was a challenging situation. Let's put it that way.
Steve.
For me, I think the one thing I would do, looking at Jerry's thing, is actually be less polite early. So we tend to be very polite when we're starting to pull people together. People are very busy. Be less polite. I had an integration where we'd hit all the big things, but actually, if we'd have upped the tempo early, we'd have had a smoother, calmer execution later on. So be less polite early on. Get people in the room early.
Be less polite. I'll take your advice, Steve. Sophie.
Yeah, I was going to say mine's kind of similar. I think it's knowing when to pull people in off the bench to support. So sort of judging the capacity that you actually have and not being afraid to kind of parachute someone in to support. We did it recently on sort of a long-term model support just to create some capacity in the CFO. And I think that sort of helped us allow to get the transaction over the line.
Yeah, whatever resource you think you're going to need won't be enough. Gavin?
Yeah, there's a theme here, isn't there? For me, it's convincing sellers to really put that effort into the data room completion, getting that data together. It makes things go much more smoothly. It's much less risk, and it makes the whole process quicker. I've often had sellers saying they're surprised by how many questions they get, but that's because they haven't got the data together in the first place. People have to remember the data room's the shop front for the company in the sale process. It's the only thing that buyers have to look at a lot of the time. And if it doesn't hang together, it can show risks where there really aren't any risks in the business. I sort of think of it, it's the broccoli of M&A, in that no one really likes it, buyers or sellers, but it does so much good for the whole process.
Alex.
Yeah, I completely agree about getting others to put more effort in. And I think the thing that I would say is try and be as lazy as possible yourself. And in the sort of least cynical way of saying this, just be really careful about where you spend your time and energy, particularly when you're in the middle of a transaction. I had a business that was being bought recently, and we had this payments platform that was sort of directly in the middle of the business. It was the heart of a lot of the processing of the card transactions. And we spent a lot of time making it sort of shiny, nice, fit for purpose, handover documentation all over the place. And the purchaser just didn't need it. They ended up replacing it within about 6 months of the acquisition of the business. And had we known that, we wouldn't have put anything like that amount of effort in. In that particular scenario, it didn't hurt us at all, but you will never have enough time during a transaction to do all the things you want. So just be really thoughtful about where you spend your energy.
Yeah, and of course, you need to carry on running the business at the same time, so this can't become all consuming, because this, like many things, will take longer than you thought. So, yeah, okay. So we're going to get kind of properly into the discussion in a minute, but let me, first of all, if I may, for those people who want to get more deeply into this with us, we run a transaction readiness assessment, which is a half-a-day event where we can get into these details, and the strapline is to find the red flags before they find you. We'll talk a bit more about that later. But let's have the first conversation, which is starting with a strategic lens and to understand how the tech picture differs between the different scenarios of merger, acquisition, and exit. Sophie, can you kind of talk us through that?
Yeah, so I guess for me, if we start with sort of M&A, I think for me, the main role that we see as investors that tech plays in M&A is on the integration side. So I think without a solid tech foundations that you're looking to integrate into, then what we tend to see is the post-acquisition process becomes protracted, it becomes a huge distraction from BAU, and actually what you end up with is not value creation, but sort of a value detraction where you've created this sort of messy monster with an acquisition rather than a sort of the greater whole being better. So I think from us, it's really important, especially if you're wanting to do a sort of buy and build platform, that you really have those sort of strong tech foundations going into any acquisition. I think on exits, there's sort of two main roles that I think the role that sort of tech plays. One is similar to what Gavin kind of just mentioned, and it's around really making sure you get the sort of maximum value potential for your business. And that's being able to demonstrate clearly through the data and the insights in the business, the sort of the value levers in the business that align to the strategy that you're presenting at exit. And arguably, if you don't have the sort of the tech set up in a way to be able to enable you to do that, your messaging at exit just becomes a whole lot more complicated because it doesn't back up your strategy. And then the second thing, which for me, I think is really important at exit, is around just kind of keeping that optionality for your exit process. So if you have a business which has got really strong technical foundations, then it means at exit you have much more optionality because you could be viewed as a bolt-on acquisition, but you also could be viewed as a platform in your own right. And, you know, in order to drive the most value and drive a competitive process, you really want to make sure that you're keeping both of those doors open going into an exit process.
And am I right that a platform business upon which others can be bolted tends to attract a significantly higher multiple?
Exactly. It's all, similar. It's kind of linked to what I said earlier about sort of the M&A, about that sort of having a really strong playbook, which has got strong tech foundations where you can show that you can buy other businesses, attach them to your own, and then actually tech isn't a barrier for that. You're able to be superior to your competitors with the ease of integration that your sort of tech foundations have put in place.
Any comments on that?
I think what's really interesting when we talk about the value of businesses is when we're in the business and we're not thinking about exit and M&A and things, and we talk about what the value is, we're talking a lot about like our investment in specific things, like our investment in technology. And in some cases, and I work in a lot of software development firms, so you see this quite commonly. There's a lot of money spent over a period of time, and that ends up becoming some kind of capital asset on the balance sheet. So develop some piece of software and it's worth a certain amount. And unfortunately, on the other side of this, when you come into due diligence and you see some of these sort of assets on the balance sheet, you've got to kind of take a bit of a reassessment of that. So there's a value that the business has already ascribed to these things that is not the same as the value that a purchaser might get from these things. And the fact that you've invested, let's say, £2 million in a software platform, somebody like me comes along and, we look at it and say, well, we could buy something off the shelf that's, similar, and it's going to be about £250,000. That's a different value of the same thing. And when we're thinking about value, particularly thinking about the value of technology, we've really got to think about what is it that the purchaser is going to see in an exit scenario, and how does this piece of technology actually relate to the future revenues, the future sort of cash flows of the business? Because ultimately, when we're talking about the transaction of a business, the value of it is really related to those future revenues. Everything else, the amount of money you've spent on technology and the rest of it's kind of by the by.
Whereas the balance sheet valuation could be completely unrelated to those things and will be an accountant's valuation, fundamentally different. Yeah. Jerry, you were going to say something.
Yeah, so it's that's absolutely true. And equally, I've also seen that looking at transactions from both sides of the fence, it feels as if all of the things that you are looking for when you're buying a business, you're looking to look into detail and find things that perhaps are going to cost you money that when you acquire that business, and therefore you might be able to negotiate and chip away at the price a little bit. Of course, if you're selling a business, you're trying to do the exact opposite and defend yourself from those. But at the same time, you're also trying to support the story, because as well as looking at the actual numbers, saying the future value of a business is about the numbers, it's sometimes also about the story that you tell about the future of the business, because that's perhaps much bigger than might at first appear. as to where these future revenues might come from. So the everything about the business needs to support that story.
My take is possibly slightly different, slightly left field. I think one of the things we have to remember as well, people are often surprised that when I'm going there as a technology person, I'm actually asking what the strategic people plan is, because actually the systems are as good as the knowledge of using the systems, and have we identified the key people that we need to retain, through that merger or the acquisition or the exit. So my strategic lens is the systems are great. I also want to know what your people plan is around those people.
I think that's a very sophisticated point to make, Steve. And I think that's often overlooked. That this, exactly as you say it, the systems you've got are only as good as the kind of embedded knowledge and how to get value from them. And indeed the embedded understanding of the vision for those things as well. If those things are lost, then, I've seen plenty of examples of companies that have actually got great technology, but they think it's of no value because they don't understand it. They don't understand what it could be. Gavin, did you want to add anything?
I think it's really important to think about the kinds of buyers that might be coming along to your company, to workshop that as well, to target and align your own strategy to it. But then also bring in a sort of friendly external person to sort of road test that against you as well. That could, it could be one of us, but it could be somebody, a commercial person in the market as well, that knows that market. So just to sort of do it externally, just so you've got something that isn't an internal viewpoint.
To test your arguments and maybe develop them.
Yeah, I guess we see something similar on that in terms of getting someone in to tell you how good you need to be, but not leaving it to yourself where you sort of take your own decision on, well, we feel like we need to make all of this sweeping change. Actually, what's right for our business, and getting someone else in to kind of validate that, so that you end up building your tech strategy with a logical external view rather than just being so inwards looking. So.
We've talked about the actual process, but your thinking, your planning needs to start considerable time ahead. And I think we meet prospects who are often surprised about just how far. Jerry, can you talk about this a little bit?
Yes, the first thing I would say is that I suppose there isn't really an upper limit on how far ahead you could plan. You can always plan long time ahead. But if you were to say, therefore, what's the minimum that's sensible, my view on that is really 18 to 24 months. That seems like a long time, but there's actually a lot to do if you want to stand a chance of making any improvements. Things do take time to plan and execute. So it's a really good idea to have at least that amount of time available.
And many people would really be shocked by that, Jerry, wouldn't they? I mean, so can you just elaborate on that a little bit more?
Well, one of the reasons is because let's say you discover that actually, in order to be really scalable, you want to demonstrate that all of your back office operations are really tight and are really well run and are efficient, because that makes for a good base for a business. Particularly if you're targeting being, say, the first company in the portfolio for a private equity business. They love it if you're a good, well run company. And the thing about that is that if that means then you're not in that place yet, but you'd like to be, then changing those fundamental systems can be quite time consuming and requires a decent amount of effort. And sometimes you can do things faster, but better to give yourself the space.
I mean, we would often talk about scalability, and getting from a business that's not scalable to one that is scalable is a significant piece of work, not a simple thing. Anyone else?
I would add to that, you've got to think about getting the business ready, but you've also got to think about getting yourself ready. And if we imagined that instead of going into a transaction process, instead we were planning a 3 to 6 month holiday where we would be largely out of the business and, on the other side of the world, on the end of an email at best, that would probably take considerable planning. There's a lot of business leaders, whether they're working in the business or they're working on the business, they are still very heavily involved day to day, and they've got to get themselves to a position where actually they can take the time completely out of the business, because that's what a transaction is. It's certainly not a 3 to 6 month holiday, but it's a 3 to 6 month period of time where at least, you're not going to be as directly involved in your business. Most people can't do that at the drop of a hat. You do need to plan for that, and you've got to make sure that let's say the transaction doesn't go through, at the end of that 6-month period of being away, have you still got a working business? The operational piece of it might be still there, but what does the top of the funnel look like? How is the prospect engagement gone? Have you sort of staked some of your future on the exit or not? And all of those things are actually really difficult to get right and get right ahead of time. So when we're thinking sort of 18 to 24 months, we're thinking partly about, is the business ready for sale, but partly also, are you, as the people ready to sell the business, able to take that time out of it and do all of the necessary diary clearing that you're going to have to do?
And I think this relates to Sophie's point before about having sufficient capacity to be able to handle that, to bring people in with the depth and knowledge of the business to be able to handle questions or to be able to help you through that process. They can't do that at the drop of a hat. As you say, it takes a considerable amount of time. Otherwise, they end up being a further load on you rather than reducing the load on you.
I also can add to that because there's another personal story, which is that when selling one particular business, as a management team, we decided that we didn't really want to publicize it to the wider team whilst we were through the planning phase. So that meant that at the time I had a really large team working for me, but I wasn't able to bring any of them inside to help with the process of getting ready, which meant that personally I was therefore absolutely smashed with work to do all of these things myself in terms of preparing things, documents for the data room and doing and initiating other programs. So it was a surprising amount of additional work, and that I'm not sure you necessarily think about. But if you're in that situation, you don't want to share. I mean, some people might choose to, but in our case, we chose not to.
Yeah, I mean, indeed, we'll come on to that kind of personal experiences later, won't we? But being smashed with work, I think, is a pretty common experience.
Can I offer a suggestion as well?
Yeah, go on, Steve.
That through personal experience, we were using exactly that 18 to 24 month model. We were a couple of months in. One of the things that we realized was actually this was about a flotation rather than a traditional M&A. But we actually realized the flotation point was going to occur after peak value for the business. Mm-hmm. And so we then had to convert to trade sale very quickly because there was effectively a bubble that we needed to take advantage of. So one of the things that taught us was early on in your planning, understand the three tensions you're working with. It's like any other project. There's time, there's cost, there's quality. So understand those three tensions that you're going to work with. That way, if you do need to get into a quick sell situation, you know exactly what it is you're trying to protect.
So, you mentioned the word project there, and I think that, one of the things when we were preparing was to say this needs to be treated as a project. It can't be treated as something that just happens under its own steam. Sophie, were you going to say something there?
Yeah, I was just going to build on that kind of value point as well in terms of, Jerry's timeline of 18 to 24 months. If you're expecting to get operational efficiencies out of any kind of change or preparation that you're doing too, you really want to be getting those in your final year so that you're getting the value of them as you go into the exit, rather than having something complete and done and then the future, home for the business, sort of seeing the benefit of all of those efficiencies. So, it's actually this kind of preparation is something that we, people might balk at this idea, but we actually start it really early on, and we start it sort of in the first 6 months of our sort of journey with a new portfolio company, where we just we sit back and we say, what do we think we need to look like at exit, and how far are we away from that right now, and let's understand what the key milestones are to kind of get us there and when they need to be done. And part of that is you kind of want that clean year at exit where you're not going through any other large kind of transformational change, and you've got that full kind of value from the changes that you've made coming through in the numbers.
That's a really good point. That there's a world of difference between talking about something that you'd like to be true and something that has already demonstrated its value is a significantly different stories. A couple of things spring to mind here. One is that something I've heard in the past is that if some of these improvements have got a certain cost attached to the mix, if a potential buyer, and I guess I'm thinking about an exit scenario here, if a potential buyer recognizes the fact that those things are necessary, then they will probably make an allowance for double that amount and be trying to chip your price for a significantly larger amount. So although this kind of cost in the run-up to an exit might be unwelcome, it's actually far better for you to be able to demonstrate your business in the state you'd like it to be, rather than for a buyer to have to work out all the things they'd like to do to dress it up to get it to that state.
I think that's actually pretty true. And I think it relates to what Sophie was just saying. So I think there's a lot of decision points you need to take about where the buyers are going to see the future value of the business, and you don't want to improve things just to hand over to them. But equally, if you're making statements about what your business could be doing in the future, you want to find a way of developing some proof points during that time that demonstrate that your business is capable of moving in that direction. I had a client which is in a regulatory area, and they were attempting to sell the business just before a significant change in healthcare regulations. And that became quite a difficult problem because they didn't want to do the work ahead of the regulatory change, because it'd be very up to whoever was going to buy the business, how you would do that change and what types of costs you'd incur. But then at the same time, it put a very definite limit on how long the business could continue to operate, because particularly in healthcare, the conformity to the regulations is a requirement to access the market. You can't sell your product if you're not regulated. And what can be tricky about that is it gives you that problem of valuation. The buyer is always going to see it as being more of a cost and more of a headache. And there are some of these problems where a seller won't see the value of solving that business in a way that's generic to all buyers. What you end up having to do is kind of take a bit of a punt, and you can go into a bit more of an extended conversation with a potential purchaser. And that's what happened in this example. There was a period where they had a letter of intent, and then there was a handover period, which included making some of these regulatory changes, which part of the transaction value was then linked to. But it's one of those thorny areas, I think, where there isn't a right or a wrong way, because ultimately the value of something is up to whoever's valuing it. It's up to the buyer. And until you've got a couple of buyers in front of you, at least, you've got to keep a lot of optionality there. And going back to that point earlier, you want to give your business as many different options in the future to attract as wide a range of buyers usually.
And of course, one of the potential outcomes is that all of these things fall away and that you're still left with the business. And so something that I think we're often pointing out is that all of these measures, 18, 24 months in advance of a transaction, if they're about adding value to the business, there's a reason why they're adding value to the business, because they're improving the business. So they are intrinsically worthwhile in themselves. Even if the transaction doesn't come off, you do end up with something which is better, more scalable, better customer service, more secure, whatever those things are. So they are worthwhile in themselves. Has anyone ever seen that the whole thing fell away, but the business was in better shape at the end of it?
I'd be intrigued to get Sophie's view on that, because I was actually involved in a situation where we went through this and the leadership team fell back in love with the business. But obviously, if you've got someone like Sophie involved, or you've got that private equity involved, I'd love to understand what changed.
I guess we had a similar situation. I'm not sure if they fell back in love with the business, but we had a process where I guess it was only during an exit process that they realized that probably their data and how they were presenting their business was not at the level of sophistication that it needed to be at for the buyers they were talking to. So that process fell away. And I think you don't want a management team to have to necessarily go through that example to sort of get the learnings from it. But I think it's, a powerful message to sort of say, are you really as exit ready as you need to be, especially if you're going to sort of financial investors where, trade buyers might have an understanding of the business, but there's a whole level of sort of data and diving into metrics that is going to be expected from a financial investor. So I think really making sure that you go once and you go well, rather than you have multiple sort of failed attempts at it, and just, it doesn't create the best environment amongst the management team unless you do fall back in love with the business, which is probably the exception rather than the norm.
I've been involved in an exit where the management team went through the process 4 or 5 times, and it was no fault of their own. It fell through on the different buyers' sides. But what happened was they got so slick at doing it. It was like changing the tires on a Formula One car by the end of it. And that last one went through very, very smoothly at a much higher multiple than the others would have done, just because they had practiced so much. They were so good at it by that point. And that's there's a positive side sometimes to going through multiple times, though not very often.
I mean, we've just had a question which is interesting about doing a mock version of the whole process. I mean, we certainly get contact from the outside world where people say, look, in 3 years, we're thinking that we'll probably be in a transaction. Can we go through a process now of assessing where we are in relation to that? Anyone seen this in any detail? Anyone seen people go through the whole process as a practice?
I certainly did. In one of the transactions where we sold a business, our main advisor literally had exactly that session with us, where they just took the people who were going to do essentially the pitching, which was myself and another colleague on the commercial side, took us through what it was likely to be like, what questions we were likely to be asked, so that we could talk about how to respond. And of course, that also helps throw up additional prep work that you then might need to do. It sort of made us think, oh, well, if they're going to ask that, perhaps we should do a bit of extra work in that area, so it's real and we're not just making things up.
I'd add to that, it's worth doing that, especially with owner managed businesses. If you can do those practice sessions, because you'd be really surprised how emotional and defensive owner managers can be when they're probed about the business and the value of their business.
I was just going to say, we've actually done something, I guess, slightly different with a recent portfolio company where we've sort of we've appointed an advisor probably 12 to 18 months before we're going to exit, to do what we call sort of proactive value maximization work with them. So sort of really understanding from their perspective who our buyers are, what the business needs to look like, and helping us kind of check in on a quarterly basis as we lead up to an exit to make sure that we're on the right track and we've all very much aligned around value that we're looking for. But also it enables us to, I can't remember who said it, but someone's point earlier, that if an opportunity comes up earlier, then actually the business is well prepared to kind of move on that and, be opportunistic rather than sort of working to a set plan.
Steve, you mentioned owner managers who are sensitive and defensive. I'm sure you weren't talking about me. Let's talk about how this whole process feels, because I was talking to someone recently who described this as the kind of worst experience of his life, selling his business. It is an intensely kind of personal, it's a life event. Steve, do you want to talk about this as someone who's been through this experience more than once?
And I'm going to presume the person that you were talking to, Graeme, actually described it as the worst experience of their life, having ended up with a wad of cash in their back pocket.
Well, yeah.
Yeah. So the point is that it is a huge, and I'm not using that word lightly, it's a huge undertaking. If you think about, most businesses are built on sales, then this is the biggest sale you're ever going to make within that business. And it's a huge undertaking, and it takes a lot of time, a lot of effort, and most people end up feeling tired. So, the reason that you need to step away for 3-6 months and, give your head a wobble is because a lot of people often say, the biggest thing that I get from people is, I wish we'd have done more, prepared earlier, but they genuinely end up tired as a result of it. It's a huge, huge undertaking. And then they have to give themselves space to also grieve the loss of the business. They were expecting it, but you've got to go through that emotional process, and you've got to give yourself time and space to be able to do that.
I think that loss part is really important. And the other thing as well, if we think about, a transaction having gone well and the wad of cash and all the rest of it, what does the day after look like? Well, probably there's some extended period of handing over the business, and that might be a small number of weeks. It's probably more likely to be a few months. And you're not anymore the owner of the business or the one who makes the decision. Suddenly you wake up the next day and you're an employee. That is a surprisingly difficult transition for a lot of people to make. And one of the things I've seen after transaction quite a few times is that post-transaction handover process really doesn't go well. And a lot of it is because of the emotional side of it. Suddenly somebody was able to call the shots and was making a lot of decisions that was not just about the business, but actually about their life and how they spend their time. Suddenly in a scenario where they can't do that anymore. And that managing that transition, managing your energy and your expectations, and managing, your exit from that process. You've exited the business, but you haven't exited the business. That takes a little bit of getting your mind around, I think.
I felt that in doing these transactions, it felt to me as if it's a bit like going to the gym. There was a lot of benefit if you just had a habit of doing things well all the way through in running the business, such that they were just automatically in good shape. Those areas were just super easy and de-stressed because I knew they were fully under control. And because all the things that came up that it almost needed to be fixed and made better almost as an emergency thing, were much more stressful and difficult to deal with. So it made me think about, really focusing in on building those good business habits right from the get-go across everything, which maybe is the right way to run a business.
One of the things I guess that I sort of noticed from the investor side is sort of the dual pressure of the process combined with the pressure of not missing your numbers as you go through sort of your BAU. And I think, obviously we see it on the way in and also when we're exiting businesses, that you need to make sure that you've got that balance right. And again, it comes back to a point I mentioned earlier around resourcing and kind of making sure that you've got clear responsibility around the exec, that you're not letting BAU slide and you're not running a great process, but actually when you come to update the sort of future buyer of a business on your numbers, you've not hit the past 2 months. And then that starts awkward conversations around pricing. So sort of prioritizing that.
I mean, it's a very high pressure time, the whole thing's the thing to try and hold on to through it all is the feeling on the day you sign the SPA, the share purchase agreement, as a seller is an amazing feeling that's quite hard to put into words. It's a more intense project than anything else you're going to do, and it bonds the team together in a way that nothing operational does as well. So one piece of advice I'd give is that make sure your exit team is people you, if not friends, they're people you can work with really well under very high pressure situations. I mean, there are teams that I still meet for lunches long after I've stopped working with them operationally, just because it's going through that sort of fire, that crucible of the exit has been a real experience for everybody.
I completely agree. I think it's make sure your management team around you, make sure the advisors and lawyers you're working with, that you're going to be in really stressful situations and you want to be working with the kind of people who are going to support you through it. And I think from a sort of investor lens, it goes all the way back to if this is, if it's you exiting a business and you already had investors around the table, your choice of investors coming from more of a partnership approach, so that that actually when you're kind of in the depths of that fire, you've got people around the table who are supportive of you and the business and are there to help you get through it. Investors do exits multiple times a year, whereas the likelihood is that as a sort of founder CEO, you might do one or two, maybe hopefully more, but you're not going to be doing it at the same volume as investors. So I think it's making sure you've got the right people who are supporting you through the process.
Okay, there's various questions in here that I'll try to come back to later. But the one which I just wanted to highlight is that someone talked about tensions in the management team, because I think, Gavin, your point about it being a bonding experience is one scenario, but the other possibility is that you start seeing how people's interests start unraveling from each other, depending on what their plans are, and that can create tensions in the management team. We've certainly seen this. It's a complicated emotional journey for everyone involved, isn't it?
You've got to be open together. I mean, you've got to talk about it and talk these things through. It's almost like it can be like a therapy thing as well. Having those people discussing it and aligning those goals at the very beginning as well. And I've had things where an owner manager was saying, "I'm going to play golf. I'm done. I'm out of it." And then as soon as the transaction happened, he was phoning up saying, "What do you want me to do? How can I help?" and very well organized, and they didn't need him for anything. And so that caused a bit of tension. So just making sure everybody's aligned on all of those different things, what each of them wants to get out of it is really important as well.
But the other point I'd raise is, I don't care if it comes across as shameless promotion, having independent advisors like us in there, we often become the trusted advisor for everybody who's got skin in the game. And the fact that we haven't got the skin in the game puts us in a very unique and very, very, I think, just an honoured position to be able to help these people through this and not actually have the skin in the game, and therefore to be able to be an honest reflector back to them.
And I think you're right, Steve. I mean, it may sound a bit overblown to say it's an honour. I think it is a privilege. I agree with you.
Yeah.
One of the things we want to talk about is value creation. So we talked about kind of 18 to 24 months before starting planning. But can we just talk about a few of the stories and experiences we've had where we've seen leaders create value in their business in the run-up to a transaction, and how that happened and how it made a difference? Gavin?
I mean, the thing to be very clear about is that the value that advisors like us can create happens at all stages of the process. So, I've been involved in origination, finding buyers and sellers, reviewing the share purchase agreement, which is not usually a common thing that you'd expect a tech advisor to do, because there are lots of risks and issues around GDPR, data protection, IP, that often lawyers aren't even that specialized to deal with, even to running integrations. So sort of two specific examples, one sell, one on buy side. On the sell side, I was involved in one a couple of years before the actual sale and came onto all the business strategy sessions as well. So I could bring in the exit specific questions that the business wasn't thinking around. Who the buyer was likely to be, what would be the business area of the buyer, how should they align to that, how is the market changing as well. Bringing in that good business practice. But being targeted meant that could be tweaked and aligned with the goal for it. Otherwise, the valuation at sale time would have been materially worse. We could see that because certain competitors were being sold and weren't getting such good multiples from it. So that's a very key thing from the sort of sell side. On the buy side, I've been involved in a company that wanted to buy a company to cross-sell to the acquirees market, but that acquiree was very regulated. So they need to do a lot of investment in their own products to be able to cross-sell that, and they didn't know that. As I was in there as a sort of independent advisor, I could see the due diligence happening on the company that was being bought, and I knew the product range of the buyer, so I could see how difficult that would be, and I could create a cost case for them, see what the investment case would need to be. That meant in the end we changed the investment thesis and we did something different and still bought that company, but it did save them, the buyers, a lot of embarrassment coming in that they would have had with their investors later when they had to change direction and show things were different. So having that tech advisor across the process who understands the things that other kinds of advisors often won't, so a commercial advisor or a legal advisor or a financial advisor doesn't have that operational technological knowledge to be able to do that directly, that we can come in and do, or any sort of operational deep advisor can do.
I've got a great example with one of my previous clients, which went through an M&A scenario, sort of merging into another business with a new private equity backer. And the very early stages of this process, there was a little bit of a focus on, what can we do to raise the value of the business? We don't quite like, how we see the valuation at the moment. And it's very easy to set hairs running and say, oh, well, we see all these different trends in the market. We've got to address some of these buzzwords in some way, and we've got to show that our business is relevant. And the thing not to do, I think, is to go into that too thoughtlessly, because at the end of the day, the valuation needs to be credible and it needs to be pinned on something that the business is doing, hopefully sales of some kind. So what we did is we looked at what the range of products the business already had and what could easily be expanded. So sort of expanding the repertoire of their products by doing the same thing, but in a few different areas. And then looking at it as a sort of technology problem. How do we do more with the same number of people? How do we make our internal processes much more efficient so that we can expand our repertoire of products and then demonstrate actually that there is appetite for this in the market and get into selling that and demonstrate, that there is more value in the business here. That is a lot of hard work, but it's the right way to do it. And one of the things we've seen, I think, a few times on the other side, if you're doing a bit of due diligence, is somebody's put a sort of half-hearted at best effort in some new product line. They've slapped some buzzwords on top of it. And, right now it'd be, we've got this new AI thing. And previously it would have been, we had this crypto thing. And they've put time and effort into it, but there's nothing to show for it. And there's this perception that demonstrating a few proofs of concepts and things will make a difference to valuation. I've never seen that be true, in all honesty. I think it's always rooted in what's selling and what are your customers buying and how is your market changing.
Actually, interestingly, I have a story which goes perhaps beyond what you're saying, because obviously a really good way to change the valuation is to do something that addresses the multiple, because of course everyone wants to sell more, make more profit, but those are hard things to achieve in a short period of time. But changing the story about what you are able to actually produce can make a difference if you can deliver it. So I'm not saying you can just put a sticker on saying that we're now AI enabled. You're right, that's not going to work. But there was a case where we were selling this service provider business, a technology managed service provider business, a hosting business, and we on purpose developed two new products that were quite different from the 300 other managed service providers in the industry, to make sure that we stood out from the crowd. One was a security-based product, the other one was a virtual hosting product, and they were both leading the market products. And we completed them and got them up and running. So way more than just proof of concept, and also started gaining customers. And the interesting thing was we didn't need that many customers for the conversation for the buyers to be excited by it, because it was actually a proper finished product. So I think perhaps it builds on it that, well, if you can do something that is real, then it is worth doing, because it sets you apart.
I guess my example is probably sort of building off Jerry's point there about sort of doing more with what you've got. So we've had it recently where we've started, for example, GRR and NRR, so customer retention, customer upsell metrics, become such a focal point at exit and something which can hugely impact how your sort of the multiple at exit is viewed. And actually just spending the time to kind of go through your customer base and understand who really are the customers which fit with your sort of strategic presentation of your customers. And actually, let's look at them in a separate category to how we look at the other customers. And what you tend to see is as businesses grow, there's sort of a tail of customers where things like your churn and your like lack of upsell will be, you're going to have worse metrics in one set, but much higher metrics in another. And actually, you haven't done any new sales. You haven't, by just recutting your data in a slightly different way, you've been able to demonstrate that your business is more valuable and get the multiple sort of hopeful multiple upside from that.
One thing I hear from private equity all the time, phrase, is just commercial strategy. And the idea of maximizing and optimizing the kind of stuff you're talking about there, which I think brings a kind of a sharpness to this area that typically entrepreneurs who've built a business just won't tend to operate that way. And the business is where it is and the customers are who they are and the prices are what we charge. But private equity will just bring a clarity and, the precision to that. Can I just ask, sorry, I'll come back, Steve, I'll come to you in a second, and Gavin, you both mentioned AI before, and there's been a question about it, and I think we have to ask at this point, to what extent does AI add to valuations? To what extent is it the case that now private equity will be asking companies, where's your AI strategy? Is that real at the moment?
So we've actually introduced AI DD as a new work stream in a lot of our deals. And I think we almost want to bucket AI into sort of two categories. One is kind of what is the operational impact that it can have in the business? Are you using it for efficiencies? Is there sort of any fundamental risk to the business that AI is a threat to? Then you want to look at the value creation strategy of AI, i.e., is there a way that you can leverage it to do more of your product, or are there new features that you can be doing with it? So I think we kind of view it in the two sort of, I think you can't, everyone wants to say that they're using AI, but I think the most examples where we see it right now is more on that kind of operational efficiency side and kind of true AI product features. Yes, they're going to be driving much higher multiples, but I do think there's increasingly a degree of skepticism around how differentiated they actually are.
But for those people who are using AI for operational efficiency, they can make an argument about their economies of scale, which allows you, and exactly. So that's a genuine multiple boost.
Genuine, and it's also something that we as investors, if they're not doing it already, we will be looking at it with them as part of a value creation plan. We're gonna double our revenue, then actually let's have a look at what efficiencies we can get along the way. So.
I think it's worth looking as well, Graeme, at the sort of negative version of that, which is to say, one of the things that I've seen a few times now is this perception that an AI native business could be highly disruptive in a relatively staid market. And the example I've got in my head is in publishing. That may or may not be true, but it does affect valuation. So if you don't have that story and that track record of adopting the technology, inevitably it actually just pushes the valuation down. And we see that, I think, spreading into more technology-centric areas. So SaaS businesses traditionally had a very high multiple, and most of that was a way of saying you can kind of capture the value of the cost of exiting your product. People would be very, very sticky, and because the revenue would, stay around for a long time, you'd put a high multiple on it. That is becoming less and less true, and it's not just because it's easier to create a SaaS business, although that is true. It's a lot easier to switch between some of these businesses now as well, and that switching cost is effectively lowering or removing the moat that was around a lot of these businesses. So you've got to think of some of these things as not just a way of developing value and thinking about demonstrating your future opportunities as a business, but also as a way of defending your current value and thinking about how in the current market or the near future, your business might be under threat in some relatively significant way.
Steve, you were going to say something.
Yeah, I think going back to the original 18 to 24 months ahead, how do we add value? I think I've got 5 bullet points that I sort of always look at. First question is, do you trust your data? And if you don't, what steps do we need to take to improve data over this period? Next one is, how standard are your processes? If you've got more exceptions to a process than a process, you haven't got a process. So how can we standardize processes? Next one is, how secure are you? How confident you are that you're secure? And again, these are all things we can measure and increase over the period, the 18 to 24 month period. Fourth one is, can we simplify your platform? So exactly as Sophie was saying, can we actually take things out of this? Can we make it less complex rather than more complex? We often think adding things in adds value. Can we make it simpler to add value? And then the final one is, having lined up those four, let's show how we've executed over the next 18 to 24 months to actually execute all of those. And then you can wrap all of that up by going, and where will AI add value in any of these processes?
Top and tail, the AI side of it. I see far more interest in the VC side, the venture capital side for AI than I do in the private equity side in more mature businesses. The VCs, often you cannot even get an investment if you don't have an AI-based business. A lot of the time, they've got it as a specific tick box. But I think that's going to get tired very soon. I won't invest in businesses if they're purely based on AI, because they will be rolled over by the models as the models expand. If there's got to be a solid business and service there in the first place that can be accelerated by AI, not the AI itself, because that will get rolled over. And I think we're going to see that. We're going to see people get tired of that in the investment side, and it'll become a normal part of governance and risk. And same SaaS did, and cloud adoption became after the sort of IT crash in the early 2000s.
Mm. But equally, look, if you've got certain things in your business, like a customer service team of 20 people or more, and you haven't AI enabled them with some kind of AI knowledge base, then you'll be losing out on 25% efficiency in that team. So that's going to be a problem, and it will affect your valuation. It'll affect your profit for sure.
One of the other key things we've seen is actually just like the world of search is changing, and how AI plays a huge role in that sort of go-to-market piece. We held an event recently with our portfolio companies and sort of an expert from our network, where we sort of had an AI and go-to-market and sort of tried to get the learnings from what everyone is seeing right now, and where we kind of think companies need to adapt, and what kind of tools, AI tools, they should be using for efficiencies, but also to adapt to the search. And if anyone's interested in that, it is on our website in our sort of entrepreneurs lab section, which covers these kinds of value creation topics as well.
So that's interesting, isn't it? Because things are changing so quickly, and maybe things always will now, that I think one of the things a business needs to be able to demonstrate is its capability to adopt to and adapt new tech and to be innovative. That businesses need to be able to demonstrate their ability to innovate, because the one thing you can be certain of is that in 5 years, things are not going to be the same as they are now. So, Sophie, that leads me on to an interesting question here, which was put directly to you, which is, what are the key things, highest priority, you wish a seller would have focused on prior to sale? Have you got a simple answer to that?
Oof. I think it kind of boils down to, what are we creating here? Like, what is the plan on a page? What is the high level sort of value creation of, we are doing this business to establish X? And I think sometimes I see a lot of management teams who kind of get so distracted by that next level down that they forget to kind of pull themselves back up and say, well, actually, if I was, take myself out of the business, and if I'm looking at this as an opportunity, what is the one elevator pitch sort of selling line for a business? And just kind of always having that as your sort of guiding principle as you go through the growth journey and also go through the exit process. And that clarity, I think sometimes it's natural. Many of you have been through the process where there's so many other things kind of on the table that you're focusing on, and they sort of lose track of the big picture at times.
Let me segue then and go into a few more questions. I got about a dozen questions in advance, and we've got about a dozen have come through. I'm trying to put these together, and one of the conversations we had previously, it also relates to the point Gavin was making about VC versus private equity. We talked about trade sale before, and I remember, Alex, you talked previously about misunderstanding the buyer's maturity in terms of their ability to conduct a process well. Have people got experience in this area? And the specific question that was asked was, what should I be looking for when selecting an investor, which I thought was an interesting question. Have people got thoughts on this?
I've got a lot of thoughts on them. I think it does come down to where you want your business to be, and what kind of help you want. And that is, from a very high level, should you be looking for private equity or venture capital or actual just, commercial loans? There's lots of different ways of funding and buying businesses. And those different models are very much predicated on what you think you're going to be doing with the business. I think one of the interesting things is that capital is becoming, at least in my perception, harder to get access to. We look at the bond rates and things at the moment, like the risk-free rate. I looked it up this morning, 4.3%. So what we're talking about here is businesses that are growing significantly above that rate. And if you're venture capital, you're now looking at kind of 15, 20x returns on the most successful businesses. That's a huge amount of growth that you need to be looking for. And at the same time, markets are becoming more and more difficult to access. So all the points that Sophie was just making about AI, like how do your customers get in touch with you? If it's by search or you've relied on search in the past, that's might be difficult in the future. And it's the same with advertising as well. We're seeing that there's a massive impact that AI is having on the advertising space, how ads are delivered, where they're delivered, and how that's all governed. So I think when you're looking at investors, it's another version of, how do you select the best members to sit on this team of people that you want around you? And you want operational people, you want people who are going to help you run your business, but your investor, some of them are great access to capital, some have got great networks, some know markets inside out. You select them on the basis of how they can add that value to your business and how it's sort of the maximal win-win when you find the right one.
I completely agree with that, Alex. I think for me, your investor is more than just capital. If you're just looking for capital, then it's probably certainly, I guess, our style is we're there for a partnership. We're there to help you grow the business in the right way for the business. And I think we have multiple ways of doing it. We sort of have value creation teams, we have wide expert networks, we have sort of chairs and relevant NEDs that we introduce. But I think fundamentally that's what it is. It's the partnership to add the additional levers into your business to achieve more exceptional growth than if you just got capital elsewhere.
There's two questions here which are linked in my mind, which is one is about considerations if you're not prepped for sale, but you're approached by multiple companies. And then the other on which I see as being linked is, should I sell during the good times or the bad? Because I think that what this is really about is, should you take the view that your business is for sale all the time? Everything's for sale all the time, including my business kind of thinking. Or should you take the view that I'll wait till the perfect time for me and then pursue it as a kind of an event? What are people's thoughts on that or experiences, or what have they seen?
The best time to sell is when it's bad for everybody else, but good for you. Because when you look at the market, often you try and find a position where you're on the up, but the rest of the competition in your market is not doing so well, or the market is starting to turn against them, and aligning yourself to exploit that is quite a good way of doing things. So, but it can be very difficult, and I think either works. But obviously, if the market's bad, you're going to get a lower multiple yourself anyway, no matter what, because the market's down.
But trade sales, am I right, often come to you when you least expect it? Is that what your experience is?
Yeah, I guess to sort of echo your point, I don't think you don't want to be sat there with a for sale sign constantly outside the door. But I think you need to make sure that your business is ready so that if it is approached, you've got the coherent strategy, you've got the foundations in place that you can choose to progress it if you want to, but also choose to sort of hold back if you think that there's further value that you can create through this stage of a journey that you're at right now. So I think it's all about optionality. And I think if you don't set your foundations up strongly at the beginning, then unfortunately you end up drawing up a 4-year plan that becomes a 5-year plan that then kind of drags, which I don't think you want to ideally be able to move, as Gavin said, kind of when the market's right. So setting yourself up for that.
There is a big difference between being sale ready and having a for sale sign outside.
To be fair, we all think about it as we want to be bought, not sold. So you want to be performing so well that people are so interested in you, they want to buy you rather than having to go through a sale process.
If I could just add to that as well, I think it's important to understand at any given point, are you willing to sell? Because if that is not top of mind or even, important, don't get into the process. There's a lot of horror stories of people who, somebody comes along and says, "Oh, I'm interested in buying your business," and they start waving around massive, numbers. That can be a huge distraction. that can, an easy way to kneecap another person's business is to get them involved in a transaction that nothing comes out at the end of it. It's for serious, minded sellers only, I think.
Yeah, you should also have a good idea of what's your baseline exit point anyway, because you may, and that's maybe worth having a chat with a financial planner in the first place personally, because what is it you want from the rest of your life? Do you want this? Are you going to be an Elon Musk and use the $1 billion you get to invest in your next business, or are you just wanting to take the money and do something with your family? And that you may be surprised you don't need as much as you thought you did, which I thought sort of is an interesting point.
If you're interested in getting deeper into this, then we provide the transaction readiness assessment that I was talking about before. Jerry, can you spend 60 seconds telling us something about the assessment and how it works?
Yeah, so along the lines of, well, it's always best to be prepared. This is essentially a way to become prepared. So we're obviously a team of experts. We've done this a lot on the technology side. We've helped loads of businesses with their transactions, help them become more efficient. What this session does is look at the ways that will actually help you maximize the value and be a lower risk and be ready for a transaction. And it's all tailored towards you as a business rather than being very generic. And so I'd encourage people to just take us up on it because it's a really powerful session and well worth doing.
Thank you all very much. There are a whole bunch of questions we didn't get to answer, and because they're anonymous, it's a little tricky. We are going to send a follow-up email, and feel free to reply to that with your questions, and we'll come back to you. Or if you want us to put you in touch with YFM Equity Partners and Sophie, we can do that as well. But on that note, I will say thank you very much indeed to the panel. Thank you to all the participants, and have a good afternoon, everyone. Thank you.